We've got some big news on interest rates south of the border, interest rates here in Canada, and of course I'm overdue for a fall market update and really an August review of prices. I'm going to get you started right now. So, big news south of the border, interest rates. Federal Reserve at the last meeting lowered interest rates by 50 basis points, 0.5%. This was actually what they were predicting, but they weren't sure whether it was going to be a quarter point or whether it was going to be a half point. There was even some speculation that if they went a half point, it was going to spook the markets. Anyways, that's a big cut. And we've done more or less the exact same thing here in the bank with our Bank of Canada. Last three policy meetings, they knocked off a quarter point each time. We're now sitting here in Canada at 4.25%. In the States, it's 4.8%, down from 5.3. So what's this mean for the economy? Well, one thing I've talked about numerous times in the past couple of years with my videos was the yield curve being inverted. And in the case of Canada and the States for the past couple of years, the yield curve has been inverted. And what that means simply is short-term debt, like you buying a treasury bond, a T-bill or a Bank of Canada savings bond, the shorter term debt, like a two-year bond, was paying more money than a 10-year bond. And when you have that happen, that's called the yield curve being inverted. Well, right now in the States, for the first time in several years, the yield curve is back to normal, and you have two-year bonds paying less money than 10-year bonds, which is how it should be. In the case of Canada, our yield curve is still inverted, but only ever so slightly so. We are at 3.5 basis points higher for the two-year Bank of Canada bond versus the 10-year. So that's pretty much neutral. 3.5 basis points, that's 0.03%. So that's flat. It would be good if Canada got to having our yield curve back to normal as opposed to it being inverted. But anyways, it's been moving in the right direction. Now, why this is potentially problematic or not is there's been a long playing kind of trope about if the yield curve is inverted, that means a recession's coming. And there's absolutely no question that these rate cuts that the Fed down in the States and here in Canada that our Bank of Canada has done is in direct response to economic sluggishness, and they're quite worried about the economy slowing down way too much. Already they're talking about core inflation here in Canada being around 2%. I mean, for anybody living here, it doesn't really matter. Prices have gone up so awfully high so quickly over the past couple of years. But at least right now, more or less, it's not getting worse. And they don't, I guess central banks, their big fear is deflation where prices actually start falling. They definitely don't want that to happen. And that's a lot of the driver behind the interest rate cuts we've seen here and in the States just the other day. What's all this mean for housing? Well, of course, if you're looking at refinancing, having rates come down is certainly going to help you with those numbers. And for people purchasing property for the first time, getting that mortgage is going to be a little bit easier. 75 basis points compared to, 3 meetings ago, that's going to be several $100s a month off your mortgage. And that definitely is going to impact people's ability to go out and purchase. Now, talking about our local market, we are slow, and it's been slow like this the entire year. I've done a number of videos and market updates where I've talked about how slow it is. That hasn't changed. We are, for August, we're at 5 or 10-year lows for sales volume. And it's kind of been like that the entire year. 2023 and 2024, real estate market's been slow. And in Waterloo region in particular, prices have more or less remained flat. We didn't see the big typical spike you see in our spring housing market. Instead, prices have remained, like I say, pretty much flat and trading in a fairly narrow range. So I'm going to talk to you right now about Detached. Detached properties came in at right around $891,000 for the month of August. And that's down from highs we saw in the spring. I think we were high as 950-ish. But they've been in that kind of, very, very high 800s, low to mid 900s the entire year. Same kind of story for semi-detached. Semi-detached, it's trading in a range, I do believe as high as 680 this spring, and right now we're sitting around $660,000. You're looking at townhouses. Townhouses are trading right at 614,000. And they're sitting in a range too, in the mid sixes, low to mid sixes for the most part. And then lastly, I'm going to finish up with apartment style condos. Apartment style condos here in Waterloo region, you can pick one up on average right around $457,000 for the month of August. And that again is in a fairly narrow range in the mid fours, 4.25 up to say 475. And this has been consistent, as I said, this entire year. So no matter when you've bought, I mean, the only one I can really think of that's down substantially is Detached right now relative to the high point in the spring. But on a month-over-month basis, like prices are flat. It's like we're sailing along this dead calm sea with very, very little activity. And I had a sneak peek as well, I gotta say. I had a sneak peek for September. Prices for Detached have come up a little bit, as you'd expect, because the fall buying season typically picks up. But the other segments I mentioned, semis, townhouses, and apartment style condos, that's flat. Prices have remained flat. We haven't seen even a blip where they've come up at all. They're trading, as I said, in those kind of narrow bands I mentioned, a minute or two back. What do I think is going to happen going forward? Well, I think it's going to continue to be slow. I think even with these interest rate cuts, people simply are tapped out spending-wise, and that's not just real estate. I've got friends with local small businesses, and they're saying, they're struggling to get customers. And these are people that have been in business 25, 30 years. That's just because of the inflation that we've seen. I mean, you've got wages have not been increasing at the same rate that costs have gone upward, and that's, I think, starting to impact people's ability to go out and purchase. Do I think prices are going to fall? No, although January, February, late December, there's usually a bit of a downturn in prices because nobody wants to be shopping at that time of year. But I really think this year we're going to just see this continued sluggish, low sales volume and more or less flat prices continue out for the rest of the year. Anyways, that's all I got for you today. Thanks so much for watching, and have yourself a fantastic day.